Hi friends, welcome to my channel Investors Arsenal. My goal here is to share practical investing knowledge and provide new investors with tools, frameworks, and insights they can apply in their own investing journey. Have your small cap or mid cap stocks recently corrected by 20-30% despite the main stock indices trading at record highs? This video discusses about exactly why big losses are so dangerous in stock investing. The video also provides practical tips to avoid them in the future. By way of an example, let's say you started with a capital of $100, right? Based on either a tip you received from your friend, broker, social media platform, or based on your own research, you invested, let's say, $100 in one stock, which you felt will give you high double digit returns in a short period of time. Unfortunately, the stock price went in exactly the opposite direction of your expectations, and you see a drop in stock price by, say, 50%. So you are now left with $50 only. Now, the typical investor mindset changes here. Instead of now expecting double digit returns, you think, how do I get my lost money back? This is what I call the recovery trap. A question for you. What percentage gain on the remaining $50 you think gets you back to the original $100? Most people say 50%, but that answer is completely wrong. The correct answer is 100%. Yes, friends, losses and gains are not symmetrical. When your capital shrinks, your future percentage gain applies to a smaller base. In this case, $50. The smaller the base, the harder recovery becomes. That's why losses hurt more than gains help. Now, here is an interesting table. As you can see from the table, you need 11% to recover your loss of 10%. Now, this is something which is manageable. Similarly, you need a gain of 25% to recover losses of 20%. Again, okay, manageable. Next, you need 100% gain to recover losses of 50%. 70% losses require a gain of 230%, right? And this is just to break even. Forget about the returns you had expected. Last but not the least, you require a staggering 900% to recover losses of 90%. Isn't it eye opening? When your capital shrinks, every future percentage gain applies to a smaller base. The smaller the base, the harder recovery becomes. 900% gains to recover losses of 90%. That's not investing, right? That's hoping for a miracle. This is why professional investors obsess over avoiding big losses and not chasing big wins. The first rule of compounding is simple: don't destroy the base. Remember Warren Buffett's two rules? Rule 1, do not lose money. Rule 2, do not forget rule number 1. Remember this: small losses are recoverable. Big losses change the game entirely. You will always be on the back foot. Protecting capital matters more than maximizing returns. And consistency beats volatility every single time. That's what history has shown. The best investors don't win by hitting home runs, they win by avoiding strikeouts. It's important to stay in the game always. Like it's said in cricket, it's important to stay on the pitch and runs will automatically flow. Similarly, if you survive in the stock market in bad times, returns will automatically flow. Hope this video was useful. Feel free to share your comments.